Mortgage loan options. Which one's ideal for you? What types of loans are available to be able to purchase as a primary home buyer, as a first-time home buyer? And what options are available if you're an investor? What options are available if you have a social security number versus an ITIN number? Today, we're going to talk about all the loan options in detail to give you enough information to understand your ideal situation and the ideal loan that you should apply for. What is the difference between FHA, VA, and USDA loan products? The difference between FHA is that FHA only requires 3.5% down payment. What does that mean? That means that you're going to have to bring a small down payment to the table. But the advantage is that FHA does not require perfect credit. It allows you to have a 600, 640 FICO score and still find options. And in some cases, you still find options to be able to use special programs additionally to the FHA loan product where you can finance your down payment and your closing costs. So the advantage of FHA is that it's insured by the government. They insure the investors and the banks that if they lend you money with less than perfect credit, with only 3.5% down payment, that you get an excellent rate, you get a great mortgage product, and you're able to purchase your primary home. So remember, it's an excellent loan product. Then we have VA. VA is Veterans Affairs Loan. This loan product is excellent for anybody that has served our country, anybody that is eligible, and we can request an eligibility certificate from the VA. It will tell us what benefit you get. Typically, you get 100% financing. What does that mean, 100% financing? It means that you don't have to bring a down payment to the table. And this loan is guaranteed by the government. That is the difference between FHA and VA. VA is actually guaranteed. They guarantee the lender that they will not have any losses in case you have a hardship and you're unable to make your payments. They guarantee that if you go through a hardship and you miss your payments or you get a foreclosure, they will make sure that bank gets reimbursed and gets paid 100% because it's guaranteed. But the benefit that you get is that you bring zero down payment. You get 100% financing, and that you get an excellent rate. And what is USDA? USDA is a loan product specifically for rural locations. So they have this loan product where you also get 100% financing, just like VA. Anybody can apply for this loan. Everybody's eligible to apply for a USDA loan product where you get 100% financing. But this 100% financing means that you still have closing costs and that you're purchasing a home in an area that is considered rural. So you can look up your map, you can Google to see what rural places are around where you live. And if you're willing to live and move to a rural location, then you can apply for a USDA loan. And then you get 100% financing and you don't have a requirement to bring down payment, which is a great benefit for you. You do, and you are subject, and all these loans are subject to closing costs. The closing costs are the expenses that it generates in order to originate a loan. What expenses are generated? Well, you have an appraisal, you have title fees, credit report, employment verifications. You have a lot of things that are going on from third parties that originate loan costs. And we have to be able to pay for those. But the advantage and the secret is that if you're using one of these programs, the sellers are able to give you seller credit, help you with expenses, and pay part or all your closing costs. So in order to understand all these loan products, I want to invite you to be able to sit down with a loan officer to be able to help you to see what loan program is ideal for you. Are you an investor or a first-time home buyer? We're going to touch on what loan options you have for each individual. A first-time home buyer, there's options and special programs. We talked about earlier the differences between FHA, VA, and USDA. Now we're going to talk about the other side of the coin, investor products compared to first-time home buyers. A first-time home buyer is able to use an FHA loan, a USDA loan, or a VA loan, and they can also use a special program along with that loan product. What does that mean? That means that the city, the county, the state, they have grants, different type of grants, but they also have different types of rules for those grants. Some of these grants are forgiven in 5, 10, or 15 years, and some other grants are only a loan that they just finance your down payment and your closing cost. In other words, you have to find the correct loan product or special program for your needs. What that means is some of these programs will have some higher rates and some will have some lower rates. Some will be forgiven and some of them you have to repay. And then some of them, if you sell the house or your investment before 3 to 5 years, then you have to repay back or give back the down payment that they gave you. So there's different products to be able to help first-time home buyers. And then I get a lot of home buyers that tell me, well, what's the benefit of me being a first-time home buyer? The benefit is that you're able to use a government loan, for example, an FHA loan, and you're able to use a state program that allows you to be able to finance your down payment and your closing costs. That is the benefit that you have because an FHA loan is typically for first-time home buyers. In order to have a second FHA loan, the requirements that you have to live 100 miles from that first house. And you can't have the same benefit of having a great rate, being accepted with less than perfect credit, and being able to get help with your down payment and closing costs. As an investor, in other words, most of the time, not always, you might have to put down up to 20% down payment. There's options. There's different loan products. There's loan products that are called non-QM, non-qualifying mortgages, that maybe are not the conventional loan products that we typically use. In other words, investors typically have higher requirements of credit. They have to have an investor more down payment, more savings than your typical loan product when you're a first-time home buyer or you're buying a second home. So there's a huge difference. And I want to be able to share that there's great loan products for investors. And right now it's a perfect time to become an investor because we manage and we have fix and flip loan products. We can help you. If you want to get into the business of becoming an investor, we can help you find financing. That type of financing that you're able to get will require savings, but we can help you where we can find hard money loans. We can get private money specifically for investors. Specifically, first-time investors typically have a harder time to be able to find these loan products, but we can help you with that. If this is your first time trying to flip a house, we have professionals, real estate agents that do flips, that can walk you through the process, and they can also coach you and teach you how to do your first flip. So just remember, this is Pedro Lira, your loan specialist. Did you know you can buy a house, purchase a house, without having a large down payment? It's possible. We have options available like FHA, VA, and USDA loan products. These loans make it available for you to be able to purchase with a very low down payment or zero down payment. Utah Housing is a product that the state offers to be able to help first-time home buyers enter and buy a house with zero down payment. What do they actually do? They actually give you a second mortgage to finance your down payment and your closing costs. So it's not true that you need a large down payment. You can actually get into your first home, purchase your first house with an FHA, VA, or USDA loan, and use Utah Housing to be able to help you finance your down payment and your closing costs. So you do not have to have a large down payment. I-10 loans, is it possible to purchase a house without a social security number? The answer is yes. You can buy a house with a I-10 number. We have local credit unions that offer I-10 loans. We have local banks that offer I-10 loans. And nationally, we have the big banks that offer I-10 loans. Basically, right now at this time, anybody can purchase a house no matter if they do not have a social security number. With an I-10 number, they can get credit and they can buy a house. They can get a mortgage. The only difference is that an I-10 loan is considered to be riskier. So the requirements are a little bit higher to be able to meet. So what are those requirements? What is the difference between the social security number and the I-10? The I-10 will require to have a higher down payment. For example, you might need to have 5%, 10%, or 20% down payment. It depends the profile and the loan product that you're looking for. But with as little as 5%, locally you can get finance within your credit unions that are available here in the state of Utah with only having 5% down payment, and your credit score requirements only 660 to 700. So it just depends the credit union and what requirements they have, or your local bank. And I also want to be able to share with you that it's just not the down payment. There's also closing costs. And closing costs are also just a little bit higher than your typical closing costs from a conventional loan. On most I-10 loans, you will have an origination fee between 1% up to 2% origination fee. That just makes your closing cost a little bit higher, but it helps you reach your dream. It helps you accomplish the purchase of your first home. So yes, you can purchase with an I-10 loan, and those loans are available locally anywhere. If you're self-employed and you're trying to qualify for a mortgage, you need to sit down with an accountant or visit your tax preparer. The reason you need to sit down with them is you need to be educated in how to prepare your taxes this year, because you have to show income. You have to show the bank that you have positive income, taxable income. And most of the time, if we're self-employed, we're trying to pay the least amount of taxes, and we use all the expenses available. But this year, we might have to leave some expenses out, not use all of our expenses. We have to be able to show income that you're originating, net income, taxable income. And you have to be able to understand if you have an LLC, or if you do your taxes on a C schedule, you have to understand how the C schedule works, what your gross income is, how many expenses you have, what is your net income, and how much you're going to be taxed. So just remember, this is Pedro Lira, your loan specialist.